So this may not come of any major surprise, but there are big banks that are seeing tougher times ahead for the U.S. housing market. Morgan Stanley is now slashing its U.S. housing market outlook. It's been in the news lately as they have shifted gears on their predictions for the U.S. housing market. What do those changes mean for the housing market exactly? I want to cover that in today's video, so make sure you stick around. Now, between June and August of this year, property prices nationwide saw their first 3-month drop since 2012. And researchers from Morgan Stanley are now believing that this decrease of 1.3% was more than just a small dip. They say it represented a change in trajectory. Anytime a big bank talks about the housing market, we'd be wise to listen. So when Morgan Stanley recently slashed its U.S. housing market outlook, we were quick to investigate exactly why. Earlier this year, Morgan Stanley only forecasted a 7% decrease in U.S. home values from the peak to the trough. Now, the Wall Street Bank projects that between June of 2022 and the bottom in 2024, housing values will decline by almost 10% overall. How did they get there to those numbers? Well, to start, they anticipate a 4% year-over-year gain in U.S. home prices this year, as determined by the Case-Shiller Index. But given that the Case-Shiller Index rose 8.9% in the first half of 2022, Morgan Stanley anticipates a 5% decline in U.S. home values in the second half of the year, which includes the 1.3% decline between June and August. The decline in housing prices won't end there. According to Morgan Stanley, the Case-Shiller Index's assessment of the U.S. home values would decline 4% more in 2023, taking the total to 10% from peak to trough. High unemployment, pressurized affordability, dubious mortgage products, and a surplus of inventory served as the foundation for the previous housing correction, which witnessed a 27% decline in U.S. home prices between 2006 and 2012. This time around, we're simply dealing with pressurized affordability, which is characterized by inflated property prices in conjunction with increased mortgage rates. According to Morgan Stanley, the median price of existing home sales is up 38% since March of 2020. Mortgage rates are up over 300 basis points, or 3 percentage points in the past 8 months, the first time we've seen anything like that since 1981. The combination of the two has caused affordability to deteriorate faster than at any point in our time series. Morgan Stanley believes that there are 3 levers that can be pulled in the future to depressurize affordability. First, in theory, lower mortgage rates and greater affordability should result from slower inflation and looser financial conditions. Second, increasing salaries, which are up 4.4% annually, might make housing more affordable. Third, if property prices keep dragging, affordability could be depressurized. Now, as long as affordability remains pressurized, Morgan Stanley expects that that third lever is really going to get pulled. And now the researchers write that up until this point, they have focused on housing forecasts up until the end of 2023, but don't believe December of 23 will be the bottom for home prices. It's not a groundbreaking statement to say that the trajectory of home prices into 24 and beyond is filled with more than a little uncertainty. Now, let's dig a little deeper into Morgan Stanley's latest housing outlook to see where the big bank believes we are headed. They claim that tight inventory won't stop house prices from falling, that it could create a floor. Demand has fallen as a result of ongoing affordability shock caused by skyrocketing house prices and rising rates, which explains why we're seeing mortgage purchase applications down 40.7% from last year. Now, it hasn't, however, resulted in rising supply levels. In October's inventory levels were 37.6%, lower than those for October of 19. This has given pause to researchers at Stanley. They say, and I quote, "Supply conditions historically argue for climbing home prices from here. If we are below 6 months of total supply, annual home price growth has never turned negative within the next 6 months, going back to the beginning of this Case-Shiller Index in the late 1980s. Now, we currently sit at just 3.9 months of supply, but this time could be very different as the ongoing affordability issues could see home prices drop despite inventory remaining so tight." Now, the research team went on to say that the fact that we expect home prices to start falling on an annual basis in March of 23, despite tight inventory, reflects how unprecedented this affordability situation is right now in the United States housing market. However, although supply doesn't keep home prices floored at zero, we do believe it prevents home price declines from becoming too large. Now, one of my favorite parts of Morgan Stanley's analysis is the inclusion of a bull case and a bear case. Now, we'll start with their bull case, which is that home prices will stop falling in 2023. Morgan Stanley anticipates a 10% decline in U.S. housing prices from peak to trough through 24. The company does have a bull case, though, in which the peak to trough reduction is estimated to be approximately 5%, and that U.S. home prices do not decline in 2023. Two fundamental tenets support Morgan Stanley's bull case: lower than expected borrowing rates and tighter than expected inventory levels. To quote Morgan Stanley researchers, in their bull case, the lock-in effect keeps inventories at the lows that we have experienced in the past year. At the same time, lower mortgage rates incentivize more purchase demand than we are currently expecting, as households view any rally as a potentially temporary reprieve and move to take advantage before the next move higher. That's according to Morgan Stanley. Now, they anticipate an average of 6.2% for 30-year fixed mortgage rates in 2023. Mortgage rates could fall below 6%, though, if the Fed is effective in taming inflation earlier than anticipated. Now, inventory levels might be tighter than Morgan Stanley currently anticipates. So the so-called lock-in effect, defined as homeowners who don't want to sell and give up their 2% or 3% mortgage rates, continues through 2023. And here's where the bear market case is argued. This is that home prices will see 20% crashes. And according to Morgan Stanley, if a severe recession occurs, U.S. home prices might decrease by up to 8% in 2023 alone, or 20% from their high to the trough. A longer and deeper recession that causes a significant rise in unemployment it's a frequent scenario that Morgan Stanley sees when addressing the bear case for property values. They believe that an intersection of weaker than anticipated demand, a greater increase in inventory than anticipated, would be more likely reason for a decline in housing prices. They believe that even if this bear scenario comes to pass, the financial crisis of 2008 wouldn't be fully repeated. Of course, it's a totally different situation. Although the bear case would clearly be bad for the housing market, they assert that the strength of the credit rules should maintain a lid on how high actual distressed transactions can go. Additionally, a mortgage service sector that is far more adept at providing consumers with alternatives to foreclosure, such as loan modifications, should prevent more borrowers from being forced into a liquidation event. So what can we take from this report from Morgan Stanley? For one, it's important to recognize how difficult it is to predict the market. There are so many factors involved, and their interplay can produce unexpected outcomes. One thing is for certain, though, and that is that the housing market will continue to produce both scenarios, both good and bad for buyers and sellers as we move into 2023. And patience may be the greatest difference maker for both. Patience in finding the right deals, patience in looking for creative investment opportunities, and patience in strengthening your financial situation. Stay tuned to the channel, and we'll do our best to bring you the most relevant, up-to-date content on the housing market, as well as various creative real estate investing avenues that may be worth checking out. So what do you think about Morgan Stanley's housing market outlook? Do you agree? Do you disagree? I look forward to reading your comments. Just please make sure to keep it civil down there, as we're all here for the same reason, and that's to go further, faster, financially. Don't forget to like and subscribe and share the video with somebody that can use it. Until we see you on the next one, make it a great day and keep on cash flowing.